Can SVOL help me generate steady income? In today's ever-shifting financial landscape, investors increasingly seek alternative strategies to navigate market volatility and generate consistent returns. One rising star in this arena is the Simplify Volatility Premium ETF, SVOL. However, the complexity of its underlying mechanism and target audience can leave even seasoned investors scratching their heads. This QA format article aims to bridge that gap, providing a comprehensive understanding of SVOL, its potential benefits and drawbacks, and whether it aligns with your investment goals. What is the core objective of the Simplify Volatility Premium ETF? SVOL's primary objective is to capture the volatility premium, a historical tendency for volatility levels to be higher than what is theoretically warranted based on expected future returns. It achieves this by selling short VIX futures contracts, which essentially profit when market volatility declines. However, unlike a simple inverse VIX strategy, SVOL seeks to mitigate extreme volatility through a dynamic hedging strategy, aiming for smoother returns and reduced downside risk. How does the dynamic hedging strategy work? SVOL employs a proprietary algorithm that adjusts its exposure to VIX futures based on market conditions. During periods of low volatility, it allocates a higher percentage of its assets to VIX shorts, capturing a larger volatility premium. Conversely, when volatility spikes, the algorithm reduces its VIX exposure, protecting the portfolio from potentially significant losses. This dynamic approach strives to deliver consistent returns across diverse market environments. What are the potential benefits of investing in SVOL? Several potential benefits make SVOL an attractive option for certain investors. 1. Diversification. SVOL's negative correlation to traditional assets like stocks can provide valuable diversification benefits, potentially reducing portfolio volatility and boosting risk-adjusted returns. 2. Income generation. SVOL distributes regular monthly dividends derived from the premiums earned by selling VIX futures. This consistent income stream can be particularly appealing for income-oriented investors. 3. Downside protection. The dynamic hedging strategy aims to limit downside risk during periods of high volatility, potentially cushioning losses compared to a straightforward VIX short position. 4. Potentially attractive returns. SVOL has historically delivered strong returns, particularly during periods of low or declining volatility. This can be advantageous for investors seeking alternative sources of alpha in a low-yield environment. Are there any potential drawbacks to consider before investing in SVOL? As with any investment, SVOL has its own set of potential drawbacks. 1. Complexity. The underlying mechanism of SVOL can be complex for some investors, requiring a deeper understanding of VIX futures and the dynamic hedging strategy. 2. Fees. SVOL's expense ratio of 1.16% is higher than some traditional ETFs, which can eat into long-term returns. 3. Short-term volatility. While aiming for smoother returns, SVOL can still experience short-term volatility due to its exposure to VIX futures and the dynamic hedging mechanism. 4. Limited track record. While SVOL has performed well historically, its relatively short track record, launched in May 2021, warrants caution against extrapolating past performance into the future. Who is the ideal investor for the Simplify Volatility Premium ETF? SVOL may be suitable for investors with the following characteristics here. 1. Moderate risk tolerance. SVOL aims to mitigate downside risk, but can still experience periods of volatility. Investors comfortable with short-term fluctuations may find it appealing. 2. Long-term investment horizon. SVOL is best suited for long-term investments as it targets capturing the historical volatility premium, which may not materialize in short periods. 3. Seeking diversification. Investors looking to diversify their portfolio with an asset that exhibits low correlation to traditional assets may find SVOL advantageous. 4. Income-oriented investors. The regular monthly dividend distributions can be attractive for income-seeking investors, complementing their overall portfolio returns. How should I compare SVOL to other alternative investment strategies? When comparing SVOL to other alternative strategies, consider the following factors here. 1. Risk profile. Assess your risk tolerance and compare it to the volatility inherent in each strategy. Some alternative strategies, like options trading, may involve higher risks than SVOL. 2. Fee structure. Different strategies come with varying fee structures. Compare the expense ratio of SVOL to other options to ensure alignment with your financial goals. 3. Investment horizon. Match the timeframe of your investment strategy to the optimal holding period for each option. Short-term strategies may not be suitable for SVOL. 4. Correlation to traditional assets. Consider the diversification potential of each strategy. If seeking low correlation to traditional assets, SVOL may be a good choice compared to certain alternative investments. Does SVOL have any historical performance data I can review? While SVOL launched in May 2021, it has accumulated a short, but informative track record. Here are some key takeaways. 1. Returns. SVOL has delivered impressive returns since its inception, particularly during periods of low or declining volatility. As of January 30, 2024, its one-year total return stands at 23.05%, significantly outperforming the S&P 500's 7.01% return in the same period. 2. Volatility. While aiming for smoother returns, SVOL still experiences short-term volatility due to its exposure to VIX futures and the dynamic hedging mechanism. However, its maximum drawdown of -12.24% is considerably lower than that of a simple inverse VIX strategy, showcasing the hedging strategy's potential benefits. 3. Correlation. As expected, SVOL exhibits a low negative correlation to the S&P 500, -0.34, highlighting its effectiveness as a diversification tool. This negative correlation can potentially improve portfolio risk-adjusted returns during volatile market conditions. It's crucial to remember that past performance is not necessarily indicative of future results. However, SVOL's historical data provides valuable insights into its potential behavior and can inform your investment decision-making. Are there any specific risks associated with investing in SVOL that I should be aware of? Beyond the general drawbacks mentioned earlier, some specific risks deserve additional attention. 1. Counterparty risk. SVOL relies on derivatives like VIX futures, which expose it to the risk of the counterparty failing to fulfill its obligations. While mitigating measures are in place, this risk cannot be entirely eliminated. 2. Tracking error. The dynamic hedging strategy can lead to tracking errors, where SVOL's returns may deviate slightly from its target performance of -0.2x to -0.3x, the inverse of the VIX. 3. Liquidity risk. Unlike highly liquid assets like broad market ETFs, SVOL's trading volume can be lower, especially during periods of market stress. This may lead to wider bid-ask spreads and difficulty entering or exiting positions quickly. By carefully considering these risks and ensuring they align with your risk tolerance, you can make a more informed decision about whether SVOL is suitable for your portfolio. How can I incorporate SVOL into my existing investment portfolio? The ideal allocation for SVOL within your portfolio depends on your individual investment goals and risk tolerance. Some general guidelines may be helpful. 1. Conservative investors. Due to its potential volatility and complex nature, a small allocation, 5% or less, may be appropriate for investors seeking modest diversification potential. 2. Moderate investors. Investors comfortable with moderate risk and seeking improved diversification may allocate up to 10 to 15% of their portfolio to SVOL. 3. Aggressive investors. For investors with a high risk tolerance and a focus on capturing the volatility premium, allocating up to 20% of their portfolio to SVOL could be considered. Remember, these are just suggestions, and it's crucial to consult with a financial advisor for personalized advice tailored to your unique circumstances. Conclusion. The Simplify Volatility Premium ETF offers a unique and potentially valuable addition to a diversified investment portfolio. Its ability to capture the volatility premium, generate income, and provide downside protection during periods of high volatility is particularly appealing to investors seeking alternative sources of return and diversification. However, it's essential to understand the underlying mechanism, potential risks, and suitability for your individual financial goals before investing in SVOL. By thoroughly researching and carefully considering your risk tolerance and investment objectives, you can make an informed decision about whether SVOL aligns with your portfolio and financial ambitions.